Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time. It is Thursday. This is normally Three Amigo time, but the one and only Dion is on a big ass cruise ship in Alaska somewhere. So again, shout out Dion. Hope you're having a good time, buddy. We'll see you next week. But we are going to talk to Matt the Lumberjack, and we got three exciting topics. You ready to go?
I am very ready to go. Miss our buddy.
Yeah, I do too. It's three Amigos are fun. It just hits different, right? We kind of all see the topics slightly different. So we'll look forward to next week. But in Dion's honor, video number one is going to be me admitting he's right. Dion, you were right. And yes, today you were right instead of not today. You're right today. And what do I mean by that? So earlier in the year, probably 12, 13 weeks ago, I called a recession Q2, Q3, Q4 of next year. I now believe, with all of the real estate crash in transactions that I see coming, I see the second half of this year being the technical definition. So in fairness, what I see today on the last day of Q2, my belief is Q2 will eke out a small positive gain. We're talking 0.1, 0.2, 0.3, but won't be negative, right? We won't follow. Q2 won't follow on Q1, but it'll be close. That said, as we'll talk about in video number two, I think July 20th is an important date, which will send the real estate market into a tailspin. And transactions will go, it'll be like they disappeared overnight. And I think that's going to have a negative impact on GDP. I think it could impact GDP upwards of 4% in the last half of the year. And there's no coming back from that. I don't see how Q3 and Q4 aren't negative GDP when transactions are down 30, 40, 50%. Just all real estate is on average 15% of our GDP. And if you whack transactions a half or 40%, that's less escrow fees, title fees, commission fees, brokerage fees, this. I mean, it blows my mind. And of course, RH, Restoration Hardware, came out with the pre-announcement yesterday, basically saying our call from 28 days ago is too positive. We must slash it. They went from 2% same-store sales growth to -5%. That's a hell of a change in 28 days. So I hear things like that. I hear Brian Lebo in Vegas. I hear agents in Phoenix. Transactions are about to fall off a cliff. And I don't know how we don't have a recession Q3, Q4. So Dion, from me to you, you were right. I was wrong. What do you think of all that?
I think it sucks that he's the one that edits videos.
He's going to clip that in and put it everywhere. Dion, you're right. Dion, you're right.
Yeah, for sure. Yeah, I mean, I think, I don't think it's wrong. I think that everything's sped up. I mean, I kind of thought things were going to speed up. That's why my Q4, Q1 call next, this end of this year, beginning of next. I think, honestly, I think that we still have a chance to hold on to that.
Maybe. Yeah.
Only because transactions can drastically fall, but other things can kind of go into its place to just to keep the bobber above water.
Yeah, we're talking little.
I'm talking because I have confidence that the government can make GDP look like we're not in recession.
Yeah, I think a lot of people assume the government plays with the numbers and they probably have some assumptions, but I can just imagine some guy with big glasses and whatnot, crunching on some massive Excel spreadsheet, pushing a button, and then I'm sure it's chaotic. I mean, if you listen to the All In podcast, they kind of share that CPI is basically, I forget what they said, like 87 people with clipboards going to resale entablments and saying, hey, what's your tomato soup cost? And what's your, whole milk cost? Like, I can't believe that's how CPI is still calculated. It's crazy.
Well, and that's the thing is the other thing is like people get it wrong too, right? So that's where again, it's, I never need look any further than, rents at 0.5 in CPI, right? to believe that there's something a little bit really lagging in the system. Yeah. And so we might really truly be in one, but then we're not in one because the numbers say we aren't in one. So I just think, again, I think I've said, on the real estate side, I think this year we're giving back some of the 16.6 that we got. I think that we still stay double digit or very high single, but then that gives the trend that we're going to go through next year.
Yeah, exactly.
And that's where I believe that correction is going to happen. but I think that, yeah, I mean, I think I still, I still believe what I said, you know, I mean, I positioned my portfolio based on that.
Yeah.
And I was really sad, Mike. I looked at 2 deals in the last 2 days.
Yeah.
And I was really sad. I had to say no on both of them. Both of them had only 6 cap rates. Yeah. And I said, what are the assumptions that you're building that 6 cap rate around?
Yeah.
And then I look at the assumptions and it was like 4.375.
Yeah.
Finance.
It's like, whoops, check. No.
I go, what bank you getting that from?
Yeah.
Because I don't believe you.
Yeah.
Yeah. And so I said to him, I go, you're actually more like 5.75. So yeah, I think that, I mean, hey, it's what we've been talking about for 6 months. Yeah. It doesn't really feel good, you know, and even us doing this as much as we do, I still don't like it. It doesn't really feel good. Like, yeah, I'm going to win a bunch, but right now I can't do anything.
No, exactly. Right, that's exactly where
it's catching the falling knife. Right now, I can't do anything. I just have to keep on watching and watching it correct.
Yeah. So there's a couple of things in here. First, I want to correct the cap rate. You're talking about a yield, not cap rate. Cap rate is a calculation without debt. So I don't want anybody blowing up my comments. We know what we're talking about.
Yes. Yield. Yes. Sorry.
Yield, not cap rate. So let's clean that up. I know there's somebody that left a comment already.
Yeah. Exactly.
What are you talking about? Mortgage rate.
I haven't even posted the video yet. Lumberjack's wrong. Yeah.
Okay. We cleaned that up. We always talk yield. So we fix that. Yes. And yield is important because, again, debt is the actual largest indicator expense. So we've cleaned that up. Right. And this is why I think video number 2 is going to be important, because I think right now buyers and sellers are kind of flying blind, right? There's some buyers who have been trying for so long that feel like they have the upper advantage and they're getting in. Hence, existing home sales were up slightly. Hence, new home sales were up slightly in April, right? Or no, May. Sorry, May. We're in June, right? May. In May, and I think July is going to just flip down on its head. And we have sellers kind of really in FOMO right now. I get calls from agents all the time now. Brian Lebo's texting me almost every day. There goes another 200. There goes another 200. Right? Yeah. Inventory is coming. So,
it is.
I see the second half of the year, really post July 20th, almost being like new price discovery. And that's messy. Yeah. That's very choppy. It's very choppy, because what happens in an environment where price needs to be reset is you're going to have a lot of people list, but aren't real transactions. They're like hopium.
Yeah.
And that's going to mess with numbers. It's going to mess with people's heads.
Yep.
And then it's going to, again, this is why real estate moves slower. It's why you won't see any price degradation this year. There's a channel out there calling for prices to crash in November. Again, as you said in July, and then you said in March, and you said last year, he's just too fast. I don't see it. It's not happening this year. We're going to go from 16.6 to sub 10, but that's still a positive number. And these are all national.
It is. Yep.
Obviously.
It is.
We certainly will have in markets, perhaps Boise being the one I brought to bear a lot, could be a problem this year. But let's talk about next year, right? Because again, you and I differ on this. And this is, it may be very much your buy box, so that's cool. But you are calling for price correction next year. So again, to clean up the vocabulary, a correction is sub 10%, but negative. So tell us why you see that. Because I again, nationally speaking, I still don't see it. It'll go from 16.6 to 9 to 4 to 2, but I still don't see the national median home price crashing or even correcting next year. What do you see?
I would never say crash, Michael.
I'm just making sure.
Yeah. It's not like I was screwing up yield and cap rate after all.
Yeah, exactly.
Need more sleep. So yeah, really, truly, what I believe is going to happen is I think that many more places start to look like Vegas.
Ooh.
Yeah. Build, inventory, more inventory. Now we're talking about 4.25 ARMs, and 10% or 12% of loans right now are ARMs. I think by the end of the year, 20% of loans are ARMs.
Sure.
I think that the rates continue to go up. I think that we are, for real rates, I think we're probably in this. I mean, the mortgage rate, I think, is for a 30-year fixed debt, I think is probably in the 7s by the end of the year, or very high 6s. It's hit the high 6s a number of times.
Sure.
And so I just think the second half of the year is build, inventory. I think Vegas is leading the way.
Oh, yeah.
Boise is leading the way.
Yeah.
This is a Las Vegas Knights Golden Knights hat, Las Vegas, in honor of the house that I'm shopping for. Give me that inventory. Give me that cash flow. I love it. I'm watching these things pour on over 100 listings a day net.
Wow.
And it's just, I mean, again, it honestly, Mike, I'm going to like for the first time ever, I'm going to have to change my buy box because I'm getting too much.
Exact. This is I hope,
too much.
Yeah. You've got to have a buy box that is manageable, right?
Yeah,
for the longest time,
crazy.
A lot of you have had buy boxes like 23, 28, 17. And what will happen is what Matt just said. Suddenly your buy box will go to 41 and then 68 and then 94. You have to, certainly if you're a full-time employee, you have to add criteria. It has to stay sub 50. Otherwise it's too noisy. And again, adding criteria to your buy box is a sign of the real estate slowdown that I've been telling you is coming, and it's now here.
So I think that is my reasoning to build. I think we build next quarter. I think we build Q4.
And just so we're clear, building is inventory. Not building, it's inventory.
It's inventory
building. Inventory.
Number of listings available of existing homes. I think that number just builds and builds and builds. And that's where I think we finally start to see, that's where I think we start to give back some of the gains that we had this year. And then I think next year that same thing happens, but on January 1st, 2023, we start at 0.
Yeah.
And so that's where I think we start to tick down. That's where I think we literally start to see next year. And like I said, it might be blip up and down here and there because you might still have some markets that are doing okay. Right now, there's still plenty of markets that are doing plenty well.
Oh, yeah.
My market's still doing plenty well. 3 houses, all under agreement within the weekend of their open house, 3 of them. Okay. Those won't close until August.
Yeah, probably.
But I still see inventory building. I still see hopium. I still see wish pricing. Those numbers will continue to come down. The 2 yield deals that I looked at were garbage. The yield was absolute crap. And that was based on the assumption of 4.375 debt or 4.5 debt. And I said, you're about a point or a point and a half off.
Yeah. You need to change that.
Yeah. I was like, so that completely, your crappy 6% yield is more like 2 and 2. It's horrible. So I just see build. I see that through the rest of the year. And then I still see building in the wintertime and the springtime. I think some players finally come out, but I think there's still a lot of people that with rates that are going to be, ARMs are going to be in the 5s. I think the rate is going to be in the high 6s, low 7s. I think there's going to be 20 or 25% of that market that's going to be adjustable rate mortgage. And it's nice now that it's 5 years. And so we kick the can down a whole lot further. A lot more of those ARMs are 5 years instead of 1s and 2s and 2 and 28 teasers, or pick your payment for the first 2 years. So that's where my number comes from. And I see the beginning part of next year kind of being tepid, but I think that, I think for the year, I think we're negative. It's not going to be like it was in 2008 where it's like going to be like 9%.
No, yeah.
But I think we're negative next year. And I think we have the likelihood of during recovery, I think we'll likely be negative the following year. And I think that adds up to get us over 10% by 2025.
Yeah. So again, I don't see any of that. Again, I think median home price is flat, basically speaking, for 5 years. These are national numbers. Your buy again, this folks, look at your buy. My opinion about a national number means 0 to your buy box. It should mean nothing. But again, I've been studying it for 30 years. I don't see it. Part of that is because the median, I believe the move-up buyer and new home buyers, the low end is just trashed, which again, if you know how the math works, it just pulls the number higher. So it may be artificial, but still, when it's reported, median home price won't have a negative number nationally speaking, but we'll see. These are year-on-year numbers.
The last piece that I would say to that is I think that move-up buyer goes away.
Oh, I agree.
So if that's the case, then the only people buying are the ultra wealthy way up here, and then the entry-level home. But the entry-level home, there's a whole lot more of.
I don't know. I don't see it. I don't see because again, where does the existing home stock come from? It's the move-up buyer. They got to get out.
Sure. Yep.
And if they're not selling, I just don't see the inventory.
But then that wouldn't. And so you're the economist. But then wouldn't that be the heavy weight on GDP? Is that the number of transactions are so down?
Exactly. That is why I think that's why I think we are going to see a real estate based recession Q3, Q4. And where I'm going with this is when that is recognized in Q1, what does the Fed do? Because the Fed is going after all assets, including housing. If real estate with a -4 or -5, we're not talking 0.5%, we're talking 5% hit to GDP because of real estate, is that enough to get the Fed to flip the script and go, ooh, shit?
Where's unemployment? If unemployment's at 5 or 6 or 7, probably not. If it's at 10, definitely.
Yeah, no, see, that's the point. I think you answered it correctly. I think unemployment is sticky. I think it's north of 5, but under 6. And I think to your point, I don't think that's enough. I think the Fed
I agree with you.
I think the Fed gets the rate, the Fed funds to 4% before they pause or cut. And which means
1.25 now.
We're 1.5.
1.5.
Yeah. So. And then we'll get to 2.25 in July.
Yep.
So
wouldn't it be nice if they did 100?
I just wish again, you've heard me talk about it. I wish they just rip the damn Band-Aid off and just take us there. So we suffer all the panic and pain, but then it's over, right? Then we can build. I hate ripping Band-Aids off one hair at a time. It's excruciating. So not how I roll. But so all of this saying is I think a recession is real estate based. I think that has some contagion for manufacturing in some other areas. I think the Fed doesn't relent. I think they have to break inflation. So I think we have a year of pain. I think the pain goes through Q2 of 2023. So we're sitting right at the beginning because tomorrow's Q3, a year of pain, a year more of pain. Because the last 6 months haven't been a lot of fun. So
it's going to be more. I think 2023 is going to be the year that everyone wishes they didn't happen. 2023 is not going to be fun. It is not 2020. Yeah. 2023. I really do not think you are going to have to pay extra for the silver lining in 2023. It is not.
So if that's what you believe, you're not, I mean, anything that's a 6 yield, I mean, you're going to be very conservative with your dry powder.
Not doing any of them.
Yeah.
I'm not doing it. I literally said to them, I said, hey, if this property sits, if you want to try and work something out, please reach back out to me. Let me know. But that's the phase that I'm going through now is I am saying no a lot.
And that's what you should do. If given what you've said, again, this is what I'm trying to tell everybody, right? If you think this is not a time to sit on the couch, this is a time to double down, refine your buy box, do the work, because eventually you're going to find that seller that goes, uncle, I'm done. I'm out. I will carry. I will do this. I will do that. Let's just close the deal. Because again, transactions will happen.
Right.
I think they will absolutely fall 50%, hence my GDP hit. Yep. But that still means 3 million transactions happen. That's a hell of a lot of transactions. If you can get a great deal in there, get a great deal.
I'm doing my very best Billy Ray Valentine. I am waiting. That's Trading Places with Dan Aykroyd. And they're selling OJ future contracts.
Got it.
I'm holding. I'm just holding. I'm holding because that price is not low enough yet.
I like it.
And I'm looking at these and I'm telling all of my brokers, I want to see more. I want to see more. I want to see more. They're like, but you're not buying. I was like, I'm not buying unless it's an amazing. I'm putting together one deal that's 30% yield day one. I will do any 30% yields day one. I promise. I will find a way to make that deal happen. But these stupid 6, 8s, and 9s in multifamily, small multifamily, absolutely not. 1000% no. Oh, but you don't understand. You have some pricing pressure on the rents. Take a flying leap. Then you raise all the rents and then I'll pay you your price. How about that? You stabilize it. I'm not paying you so I can stabilize it. I know what I'm good at.
Yeah, that's not a lot of fun. Well, episode 1 was a shout out to our boy Dion in Alaska. Dion, you were right. I think the recession's Q3, Q4. Matt, where can people find you?
Lumberjack Landlord on YouTube and on Instagram at 11:30 a.m. Eastern time. We're still going to do our live stream this week.
You're awesome, man. Thanks again.
It's fun. Thanks.